Hello and welcome. Doing something a little bit different today, transitioning from the CAP STRAT This Week structure to focusing more on the outlook by CAP STRAT. So Mike, let's get right into it. Let's start with our market regime framework. We have talked a bit about these different regimes. Now we have moved into the bumpy landing. Why have we decided now is an appropriate time to move into the bumpy landing regime?
We're coming out of a no landing that was pretty short-lived. Bumpy landing started in mid-May, and the reason for that is we've got increased confidence that the disinflationary trend, the year-over-year inflation number coming down, that is intact, although bumpy. And then we've also seen some weakness in incoming economic data that gives us more confidence that inflation is on its way down. So we'll unpack those factors and what do they mean for things like liquidity and what's going to do well in this bumpy landing regime.
All right, let's dive into those ideas a little bit further. We can start with our inflation forecast, and you can see that kind of bumpy disinflation outlook that you talked about earlier. Certainly not expecting inflation to increase notably here in the forecast time horizon. And just wanted to talk about why we have confidence in that outlook. And I think it starts with the sources and levels of inflation underlying that overall PCE forecast.
Yep, that's definitely one piece, the mix, if you will. Looking at goods shelter, services ex shelter, what was worrisome was the green line going up. Worried about a wage price spiral dynamic, the services area of the economy most sensitive to wages and the lagged effect of wages in a tight labor market. What's great news is the April CPI report knocked the top off of that green line. And what's even better news is if the inflation data comes in over the next 2 months, just like it did for that April report, which is not a high bar, that's about consensus, you'll see that green line will fall back towards a much more benign level. And this is what the Fed will be looking at when they meet in July, hopefully, if all is status quo. So the mix becoming far more benign. We talked about the level. It's going to be bumpy for a while, but then starting to really accelerate downwards as we get into early next year for sure. The type, where we talk about the lead and lag.
Yep.
So within these inflationary basket, we've broken it out by different, by the mix, but also you can take the items in the basket and say which ones are good leading indicators of future inflation, which ones show the lagged effects of past inflation. What does that mean? Perfect example is if used car prices were rising right now, we would not feel confident that the disinflationary trend is intact, because if used car prices are rising, that means in about 6 to 12 months, car insurance prices are going to be rising, car insurance lagging. The inflation we're seeing right now is much more of those lagged components, which is good to see. It gives us more confidence that we're probably not going to see a big acceleration in inflation from here.
Right.
So the level, the mix, the type, all those things give us confidence. The disinflationary trend, although bumpy, is intact.
Yeah, and you mentioned inflation will be, one of the things that the Fed is theoretically looking at when they get together in July. Another thing they'll surely be keeping their eye on is the labor market, right? So you have this one side where inflation may be coming down. That's good news if you're looking for cuts. But the other side of that equation is we don't want the economy to slow too much and go into a recession. So what we're looking at here, you can see, blue line, job openings per unemployed person, green line, total private average hourly earnings. And post-COVID, we've seen some significant shifts in both of these factors. What are we looking at from a labor market perspective?
Yeah, this is one of the biggest reasons why we have confidence we're not going into a wage price spiral, because the balance in the labor market has improved so much between jobs and workers. That blue line is back towards pre-pandemic levels, and it's happened in a benign fashion. It's happened through increased supply of labor from immigration and decreased job openings. What hasn't been required has been layoffs, which is great. If we were to overlay the quits rate, it would almost follow that blue line in terms of trend. So those two things together are great leading indicators of wage growth. They're both heading down, which means we feel confident wage growth here over the next 3, 6, 9, 12 months should head back down towards pre-pandemic levels as well. Something that's totally different from the 1970s. In the 1970s, it looked like the labor market was restoring balance, but average hourly earnings on a year-over-year basis kept accelerating. That's not what we're seeing here.
Yeah.
So it gives us more confidence that that disinflationary trend is intact, even though that seems a bit out of consensus right now.
Yeah, and this is particularly good news because this is that wage price spiral that you were talking about earlier, right? That's so difficult to get out of. You can see this trending in the other direction here. What is slightly less good news is economic data surprises relative to expectations, right? We've seen, in 2023, a lot of positive economic data surprises, but that has flipped pretty good here recently with some economic data coming in pretty disappointing. What is it that's been disappointing, and how do we view that?
The type of data is very important. We always differentiate between survey-based or soft data and hard data, meaning things like actual retail sales. So what's been surprising, a lot of it has been the survey-based data. The survey-based data has broken down before. In late 2022, it was breaking down as well. And all of it was saying, hey, perhaps a recession is coming. That ultimately didn't transpire because there wasn't a handoff from the survey-based data, we think things are going to be bad, to the hard data. Hey, people are actually making changes in their decision-making behavior. So we're taking that bit with a grain of salt. But what is more worrisome is retail sales, construction spending, those things coming in weaker than expected. I mean, that's hard data. So this negative economic surprise, the speed of it is concerning, and the level of it. I mean, this is the biggest negative surprise in the last 5 years, and it's happened here very quickly. If ultimately this is just a bump and the economic data stabilizes, then everything's fine. But if this continues to move in the wrong direction, that's where economic growth forecasts would have to start to come down. Yeah,
exactly. And speaking of economic growth forecasts, we've got the forecast here, 1.82% into Q1 of 2025. The idea being there's maybe a little bit of room for error here for growth to come down to a more sustainable level. But of course, we or the Fed doesn't want to overshoot that and push us into a recession. So still calling for that sustainable, although lower level of economic growth here for the near-term future.
And that's validated if you're looking at nowcasts of Q2 real GDP. This negative economic surprise we've seen here since the beginning of May, it's really, it's cut that almost in half. So at the beginning of the quarter, it was looking like we might see 4% Q2 real GDP growth, and now to a much more reasonable level in the twos. So a normalization, a slowdown for sure.
That GDP Now forecast coming much more in line with some consensus estimates across the market. So let's take some of these things together, inflation and economic growth, and let's talk about what the Fed could potentially do with that. So here we're looking, dark blue line is the federal funds target rate. The blue line is the based on the inertial Taylor rule. Do you want to walk our viewers through what the Taylor rule is and what it is suggesting right now?
The Taylor rule, it's a prescription for where the Fed should move the federal funds rate based on incoming inflation, expectations for inflation, economic growth, how those things are trending relative to target. And the policy prescription right now is the Fed should have already started making adjustment cuts. And that's just based on the data and reasonable assumptions. And then as we get towards later in the year, when the level of core inflation is going to come down quicker, that's when they should be cutting pretty quickly. And they're not talking that way. So in our view, the data suggests they should cut in July. Maybe June's too soon, not necessary, but July, November, and then December or January. But they're talking as if it's not going to happen in July, and it's certainly not going to happen at the June meeting. And that's worrisome because they have a habit of being late. Back at the beginning of this big inflationary spike, an inertial Taylor rule was saying you should have started hiking in mid 2021, mid to early 2021. They didn't hike until about a year later. And that's why they had to hike to the levels they had to hike, and that's why inflation got to where it is. It's a reason. So in our view, they should cut in July. As of now, it looks like they're talking themselves out of it. which is also an element of the bumpy landing. In the bumpy landing, nothing's easy. Nothing is a clear shot. Some data comes in and it looks like we're headed towards a recession. Other data comes in and it looks like we're never going to be able to get inflation down and cut rates. It's a much more productive environment for stocks and bonds, but it's still very volatile.
Yeah, and I think this chart, maybe not directly, but it kind of speaks to the idea of if inflation is going to get down around 2% in the next 6-9 months here, the Fed should be cutting healthily before then.
Yes.
To get closer to neutral as inflation gets closer to target, right?
Right.
So when the Fed is able to start cutting, what would that mean for our liquidity forecast? You can see here we still expecting liquidity to modestly improve in the second half of 2024. What could changes in Fed policy do to this forecast?
If the labor market starts to deteriorate more rapidly, right now survey-based measures of hiring plans have deteriorated a lot, but that hasn't passed through to jobless claims, people actually getting laid off. If that were to happen, then the whole regime around rate cuts would change and liquidity would rise much faster. That's bad news first, good news later. The market would have to deal with that. But we're in a position right now where if the bumps in the road become potholes, inflation should be at a level where the Fed can cut if necessary, right? So we look at this liquidity forecast as biased to the upside. If there's going to be a surprise, it's most likely going to be in better liquidity because the data is worse than we expect.
Yep. So let's wrap this up for our viewers here and talk through these regimes and what could potentially look good or better in these various regimes. You talked about the bumpy landing, and you said nothing comes easy. This performance looks all right.
Right.
So how do we think about different areas of the market within these different regimes?
It's historically been a productive environment for stocks and bonds. And we'll take the bond piece first. The reason why it's productive for bonds is because the data is very hot, cold, hit or miss. Some pieces of data will come in and say, oh my gosh, the labor market is cooling too fast, and we're at the risk of going into the hard landing, which is by far the best environment for bonds, right? So that's where you see the fits and starts. You also see inflation continuing to come down, and the Fed will probably be able to cut, so you could see why that would lower bond yields, raise bond prices. The stock piece is a little more nuanced. It requires a little bit more context. The last couple bumpy landings that we were in, they occurred alongside an AI boom. And so the S&P 500 participated in that better than most indices outside of, say, the Russell 1000 growth or the NASDAQ 100. So we think valuations here and starting points are appropriate to talk about. In the past, what's happened in a bumpy landing is investors have sort of sought shelter in companies with a lot of cash on their balance sheet, strong profit margins, and or sort of secular thematic growth stories. Those have been the areas of the market that have done well, but you can't keep going back to that well. It's pretty much run dry. Those secular thematic growth stories like AI, things like that, those trades are so crowded and they're so expensive. We doubt this bumpy landing is going to be as exuberant for that relatively narrow area of the market as the prior bumpy landings were. And you can see that in our valuation framework.
Yeah, exactly. Let's look at that here. So looking at valuations of different areas of the equity market relative to their own long-term trends, and I think the number that jumps out most on this slide right here, NASDAQ 100, 40% above its long-term trend, speaking to those valuations that you were referencing earlier.
Right. If you're trying to play the bumpy landing and you say, these are the types of companies that worked before, and you're going to buy them now, you're playing with fire.
Yep.
If the NASDAQ 100 were to come back down to its long-term trend in an extremely orderly fashion over the next 3 years, and you bought today, you would lose 5.26% annualized. So you're playing a losing game. We think this bumpy landing, it's quite possible that the S&P 500 or the NASDAQ sort of goes sideways to maybe trend a little higher. But what'll start to happen as we get closer to rate cuts, which we think are definitely coming, and we all realize that, yes, the economic growth is slowing, but it's still at an acceptable level, is other areas of the market will participate much more, such as small value, where here we're 15% below trend. If we revert to that trend, meaning we catch up to it in an orderly fashion over the next 3 years, you would get 17% annualized. Even though the timing might not be perfect, I like this a little better than I like that if I'm an investor with anything more than a couple days or couple week time horizon.
Right. Yeah.
Which is most of us think.
You need a lot of things to go right here.
Yes.
To justify a buy at this point.
Yep.
Awesome. All right. Well, that will do it for the first edition of the Outlook by CAP STRAT. If you have any questions or comments, please feel free to reach out.